Hello and welcome to this presentation about accountancy. My name is Nick Stevens and I'm an assistant manager at the accountancy firm Saffery. I've been working with my colleague Michael Strong to produce these webinars for delegates of the Southwest Creative Technology Network. This is an overview of what topics we will cover in this presentation. We will firstly look at the key considerations and first steps you should take when setting up a business. We will then look at the day-to-day bookkeeping and financial management of a business. We will run through cloud accounting software, including what it is and the advantages it could bring to your business. And finally, we'll touch briefly on the tax relief available for research and development and other creative industries. So what do you need to consider when setting up a business? So once you have your business idea, you'll need to do your research and prepare an initial business plan. This is essentially your roadmap for your business that outlines your goals and details how you plan to achieve them. This is particularly important not only for you, but if you are considering obtaining third-party finance or investment. They want to know that your business is sustainable. You'll need to decide on a legal structure, whether this is as a sole trader, a partnership or company. The structure you choose will have an impact on how you or the company is taxed and the legal duties placed on you. It is therefore important to get this right and seek advice if required. An accounting system will allow you to keep track of all your business transactions, for example, all your sales and purchases. There are lots of different software providers, such as Sage, Xero, and QuickBooks, so trialing a number will allow you to decide on which one is best for you. We're going to cover accounting systems just slightly later on in the presentation. You need to make sure you keep your business transactions separate from any personal ones. This is particularly important if you operate as a company, because it is a separate legal entity. Even if this is not the case, it'll make it a lot easier to calculate your business results at the year end if you keep them separate. And lastly, you're going to need to consider setting up a business bank account and also notify any relevant parties, such as HMRC, that you are now trading. Over the next two slides, we'll have a look at the differences between registering a sole trade business or partnership over a company. We'll firstly take a look at the sole trade partnership setup process. As you can see, it is generally fairly simple. Once you've decided this structure is right for you, you'll need to choose the name that you wish to trade under, understand the records that you need to keep, and register for taxes through HMRC. There are a number of additional steps you'll need to take in order to register a company over a sole trade or partnership business. As it is a separate legal entity, you'll need to appoint directors, decide whether you want a company secretary, and also choose who will be the company's shareholders. The directors will be those responsible for running the company, whereas the shareholders will be the owners of the company. You can of course be the sole director and shareholder of the company, but you can also appoint others if needed. You'll need to have certain legal documents in place that explain how the company is run. These are called the Memorandum and Articles of Association. The articles set out any restrictions on what the company can do and how decisions will be made. You can use standard model articles of association or change them to reflect your particular requirements. If, for example, you might want to include a restriction on transferring shares to other people. Finally, you'll need to register your company with Companies House. There are a number of formation companies that can do this online for a small fee. The process is quick and fairly simple once you know the structure and who will be the directors and shareholders. VAT, or value added tax, is a tax charged on most goods and services in the UK and the EU. We won't go into great depth on this presentation, but you'll need to know when you're required to register for VAT when you're setting up a business. You must register for VAT when any of the following applies. Your VAT taxable turnover exceeds the current threshold of £85,000 within a 12-month period. You expect your VAT taxable turnover to exceed the threshold in a single 30-day period, or you only sell goods or services that are exempt from VAT, but you purchase goods to use in your business to the value of or more than the threshold from VAT-registered suppliers in the EU. When these apply, you must register within 30 days of meeting any of these criteria. There are times when you don't meet these criteria, but it would be beneficial for you to register. In these cases, you can voluntarily register, so it's worth bearing this in mind. If you do register for VAT, do bear in mind you may be able to claim VAT on business transactions prior to your registration. You generally have 4 years to claim VAT on goods you have in your business, 6 months for services. There are also a number of VAT schemes available for businesses. The most common is the standard VAT scheme, or commonly called the accruals basis, where you account for VAT on the date of the invoices. There are other schemes available, such as the cash basis and flat rate scheme. The cash basis allows businesses to account for VAT when you receive the money from your customer and when you settle any purchase invoices. The flat rate scheme allows you to pay a fixed rate of VAT to HMRC, which reduces the administrative burden placed on businesses for preparing VAT returns. There's no one glove fits all, so it's worth comparing the schemes available to you and just seeing what suits your business. We won't go through this in great detail, but the purpose of this slide is to make you aware of your responsibilities that are placed on you when you start to take on employees. You normally need to register as an employer with HMRC when you start to employ staff and must do so before the first payday. If you do decide to pay yourself a salary as a director, but employ no one else, please do bear in mind you may still need to register as an employer with HMRC, even if as a director you are the sole employee of the company. Once you have registered, you'll need to decide if you will run the payroll yourself with suitable payroll software, or choose a payroll provider to carry out the service for you. You'll need to ensure you have the correct insurance in place, sign contracts of employment, and adhere to all the auto-enrolment pension obligations. As mentioned previously, we won't go through this in great detail, but it's important to have an awareness at this stage of all the responsibilities that will be placed on you. We now turn our attention to the day-to-day bookkeeping and financial management of your business. There is a good quote on screen by Sir Richard Branson, where he once said that one should never take your eyes off the cash flow because it's the lifeblood of business. This serves as a good reminder to us that poor liquidity in a business causes many businesses to fail, even within the first 5 years. It is therefore important to focus on cash flow management as well as profit levels. To help maintain your bookkeeping and business reporting, you'll need to decide on some suitable accounting software. Accounting software is the tool you'll use to record and process accounting transactions with functionality to deal with such areas as the cash book, bank reconciliations, maintaining accounts receivable and payable ledgers. There are a large number of software options available, whether that is choosing the provider or deciding between desktop or cloud. It's important that you trial the software to make sure that it suits your business needs. We will cover the advantages of cloud accounting software shortly in this presentation. You'll need to hold your business records for at least 6 years. This does not necessarily have to be in paper format. You could hold them electronically if that is easier, but you must retain them in case HMRC needs to inquire into any of your self-assessment tax returns. Reconciliations will form a key part of your bookkeeping. These are performed to check the accuracy of your accounting records. For example, you may need to perform regular bank reconciliations to ensure that your bank balance in your accounting system agrees back to the bank balance per your statements. This is one type of reconciliation, but you may also need to reconcile your VAT, payroll, or loan balances. Reconciliations are important, and regular reconciliation will save you time later on if you do come across a problem with your accounts. A key point to bear in mind is that you should set time aside regularly to complete your bookkeeping. It is much more manageable when you do little and often, opposed to leaving it until the end of the year. As I mentioned earlier, cash flow is fundamental to the success of your business. This is especially the case with startups. You therefore need to not only monitor your profit, but also set some time aside to ensure you have the cash in your bank account to pay suppliers and staff when they fall due. Most accounting software has some ability to produce cash flow forecasts that will help monitor your business liquidity levels. You need to track and monitor your spending to make sure you do not have any unnecessary costs. You can aid the monitoring of your expenses by setting up appropriate nominal ledgers and tracking categories within your accounting software. This should allow you to easily see what areas are incurring the largest expense. Your software should be used as a tool to set forecasts and budgets and monitor them to identify issues early so they can be resolved. Fundamentally, your time is money. You need to minimize the amount of time you're spending on admin duties so you can focus on your key business. Cloud accounting software can assist with this by making use of such functionality as automatic bank feeds. These automatically bring transactions into your software directly from the bank account, which minimizes any time you spend inputting or importing these transactions. And lastly, the financial goals are a powerful tool when it comes to maintaining the health of a business. They allow you to monitor and adjust your course based on performance, which means you're more likely to achieve your business aspirations. You, however, need to set realistic goals and be realistic about what can be achieved, as unrealistic goals can be counterproductive and cause great strain on your financial resources you have available. Whichever business structure you choose, there will be annual accounting and tax compliance requirements. A sole trade is a simpler structure and does not necessarily require you to prepare annual accounts. However, we see that most businesses do choose to prepare them, or at least a profit and loss account. This is because it helps to complete your self-assessment tax return, and also helps you monitor business performance. It would also be a requirement if you ever needed to obtain external finance or investment, as they are likely to want to see the results of the business. Limited companies, or limited liability partnerships, which are sometimes referred to as LLPs, both have statutory obligations to prepare and file accounts with HMRC and Companies House. They also have obligations to prepare tax returns, which are filed with HMRC. The tax treatment is slightly different. Companies must prepare corporation tax returns and normally file these within 12 months after the accounting year end, whereas LLPs must prepare partnership self-assessment tax return, but the individual partners will be taxed by their personal self-assessment returns based on their profit allocations. Financial statements usually consist of three primary statements. The statement of financial position, which is previously called a balance sheet, which shows the entity's assets, liabilities, and shareholder equity at a certain date. The income statement, previously called the profit and loss account, shows the results of the entity's operations and financial activities for the reporting period. This will include all your income and expenses. And a statement of cash flows, which summarises the cash flowing into and out of the entity. We will look at an example of these on the next few slides. You may also see a statement of changes in equity and other notes, such as the accounting policies or detailed notes to support the figures in any of these primary statements. This is an example of a statement of financial position, or balance sheet as it's previously called. It provides a snapshot of a business at a point in time. These are prepared at the end of an accounting period, like a month, quarter, or year end. In comparison to the balance sheet over years, helps to gauge the financial health of a business. You can see that it lists all the entity's assets and liabilities at the top to arrive at the net asset position, i.e. the book value of the company, whereas the bottom half shows the capital and reserves, showing what is attributable to the shareholders or owners of the entity. You can see how it gets its name, or previous name, because the statement's net assets must equal the capital and reserves, so therefore it should balance. The income statement, or profit and loss account, as it was previously called, is a primary statement that shows the profit and loss over a period of time. You'll see that it shows the turnover at the top and deducts all the expenses of the business, for example, cost of sales, administrative expenses, to arrive at the net profit for the financial year at the bottom. Lastly, we have the statement of cash flows, which summarises the amount of cash and cash equivalents entering and leaving the entity. Its particular focus is on the types of activities that create and use cash, which are operations, investing, and financing. Operating activities consist of revenue-generating activities of a business. The investing activities constitute payments made to acquire long-term assets, as well as cash received from their sale. An example of investing activities are the purchase of fixed assets. And finally, financing activities. These constitute activities that will alter the equity or borrowing of a business. Examples are the sale of company shares, the repurchase of shares, and dividend payments. We are now briefly going to touch on the different tax treatment between sole traders and companies. The main separating factors between sole traders and companies is how people are positioned in the business from a legal standpoint and how the business is taxed. Companies are their own legal entity and are considered separate from shareholders and directors who have limited liability. Individuals are not easily held accountable for the actions of the company. Whereas a sole trader, on the other hand, has little separation from their business. The sole trader is legally the owner and is responsible for debts and liabilities. A sole trader must pay tax on business profits, broadly income minus expenses. They are currently required to pay Class 2 and 4 national insurance and income tax on all taxable business profits. A limited company must pay corporation tax on all its taxable profits. Directors of a limited company are taxed on earnings via PAYE and also required to complete tax returns. Limited company shareholders must pay income tax on dividends and certain types of distributions made by the company. So what are off-payroll rules, or IR35 as it's commonly known? IR35 is a piece of UK tax legislation. It's designed to close a loophole in the tax system where workers could use a limited company structure in order to pay less tax. It looks through the company to see whether in reality it is more like an employer-employee relationship, and therefore the worker should be taxed as an employee. This is referred to as a deemed employee. The legislation is complex, but you need to be aware of this legislation if you provide services through an intermediary, such as a personal service company. So what is changing from April 2021? Medium and larger engagers in the private sector will be responsible for determining whether a contractor falls within IR35, which is not the case at the moment. There will, however, be an exemption for small engagers. In these situations, the personal service company, or PSC, will retain responsibility for determining whether IR35 applies. This change had originally been planned to take effect from April 2020, but due to the COVID-19 outbreak, it has been delayed a year until April 2021. However, you may find some businesses who have already started to change procedures and have stuck with the April 2020 date. It's also useful to know that HMRC has an employment status checker online, which you may find a useful tool to find out whether you fall within the IR35 legislation. You may be familiar with the term cloud software, but what is it when we talk about cloud accounting software? Essentially, cloud accounting software is where the software is hosted on remote servers and you access your data through a web browser. This is different to more traditional desktop software, but is usually installed directly on your personal computer. This brings some advantages, which we'll talk through on the next few slides. There are many cloud accounting software providers. You may have heard of some of the more prominent names, such as Xero, Sage, and QuickBooks. But there are others, such as FreeAgent and FreshBooks, who all have cloud accounting software platforms. They all fundamentally do the same, but they have some functionality differences and different pricing structures, so it's important to review them to make sure you select one that suits your business. We would suggest trialing the software so you get a feel for the layout and functions to make sure you can get what you need from the software. There are many benefits with cloud-based accounting software. They bring a paperless system that will allow you to maintain all your records digitally. These records will be easy to access, as the majority of cloud-based systems allow you to log in from wherever there is an internet connection. The login process is normally done directly through your web browser, so this should allow you to even access your records remotely through your tablet or mobile phone. The software is affordable, as it is typically priced at less than £20 per month. This gives you full access to the software, which is updated regularly, and because it is held on external servers, there is no need to manually install updates directly to your personal computer. This will all be done in the cloud for you. This also ensures that your software is kept up to date with the latest security features. And lastly, the software is designed to be user-friendly, so it is built for those that are not accountants or had any significant financial training. There is plenty of support and guidance online for those that need an extra hand in a particular area on the software. The benefits bring many opportunities for you to really focus on your business growth. The new open banking regulations and direct feeds on some software bring us closer to real-time information. This enables tasks to be automated and allow us to have up-to-date information to make better business decisions. You can add many users to the software, with differing levels of permissions. This allows you to more easily collaborate with teams remotely, including your accountant. All of these opportunities allow you to focus on what is important, which is driving your business forward. It removes you from completing tasks that once took up a great deal of your time. In addition to the functionality built into the software, such as bank feeds, there is an ever-growing list of external add-ons that can link in with the software to make your life even easier. For example, with Xero, there are over 600 apps available with an ever-growing list that can make your business processes even smoother. To give you an example, there is some software called Receipt Bank. This software allows for receipts to be photographed with a mobile phone, and all the financial data automatically extracted and imported into the accounting software. Something that could have taken hours has been minimized to potentially minutes. These do sometimes come with an additional fee, so it's important to weigh up whether the additional cost is worth it. Research and development tax credits are a government incentive designed to reward UK companies for investing in innovation. Companies that spend money developing new products or processes may be eligible for R&D tax credit relief. This could be in the form of either a cash payment or a corporation tax reduction. It could therefore be beneficial even if you're a loss-making company in the early stages. The remit is wide-ranging. It can take place in any sector. So it is something worth looking into if you think your company may be eligible. Qualifying expenditure can range from staff salaries to materials and consumables. There are two other tax reliefs available for creative businesses that are worth mentioning. The patent box allows qualifying company to be taxed at the lower rate of 10% for corporation tax. The company must own or exclusively license in the patent and undertake qualifying development on them. Lastly, there are 8 other creative corporation tax reliefs that are worth you knowing about in case your company is eligible. We won't go into these in great detail. They broadly allow a larger deduction or potentially a payable tax credit on the taxable profit. We will list them on the next screen. You can see here that these are the 8 creative tax reliefs available, which, as you can appreciate, are complex, so we won't go into them in great detail in this presentation. But if you do think your business fits into one of these areas that may qualify, it may be worth getting in contact to see if there's something you should explore further. This brings us to the end of the presentation. I hope you found it useful, but please do get in contact with myself or my colleague, Michael Strong, if you have any questions. We are also offering a free 30-minute consultation to the Southwest Creative Technology Network members. If that is something that you would find helpful, please do get in contact with us. Thank you again for watching, and I wish you all the best with your business ventures.